And we're live.
We're back for episode number 6. How's it going, everyone?
Well,
And
I'm
Lewis,
doing good. Everyone else is.
Everyone else is currently nowhere to be seen, but we do expect some people to show up later on, right?
That's it.
That's the idea. Let me just get on the old Twitch, get it on there just in case it's not broadcasting. Oh, there we are. We are live. I'll get it on. Any audio issues? Do you expect an advert before we start, as it always does?
You generally get an advert, don't you?
Got a purple ring at the moment. It's going. Come on. Still spinning around. Oh, no. This video is unavailable to subscribers of investor interest. You put early bird? What's that about? This video is only available to subscribers of investor interest. You can't even subscribe at the moment. So what's that about?
Well, I have no idea on that one.
Oh, we got an ad. We could be in business.
Just mute the volume.
It's just obviously my TV is just a bit of a brain fart when it comes to trying to get online this sort of stuff.
It's very loud.
I'll turn it down then. I only wanted to make sure that we've got the audio just after the first couple of teething issues we had on first 2 episodes where it was just me talking and your audio had not worked. Right now, is that enough?
Not as much as before, no.
Are we good? Oh, there we are. Those handsome devils. Right
then.
Faffing around with all that sort of stuff. Let's do a proper introduction. So I'll go first this week because I think I put you on the spot last week. My name's Dylan Whiteley. I'm currently a chemical engineer, and I've been I've been interested in investing now for maybe since 2015. I've currently got a reasonable sized portfolio. Well, I think it's reasonably sized portfolio in a ISA account, and I do trade. Well, I say trade. I've invested in various stocks. I am looking to trade with regards to spread betting and maybe getting into CFDs later into the future.
Yeah, same for me. No.
They're gonna ride my back all the way to the top.
Let's just cut the fluff. Lewis. Well, my name's Lewis, and I've had a similar interest in investments, just about understanding how to grow money as opposed to eroding money. I've had a kind of a lengthy time, similar to Dion's. Well, since Dion was the one that got me interested in it, and since then, I've slowly been building a pot. It's not as substantial as Dion's, but it's a start.
The priority is to go with it.
Well, that's it. Yeah.
Courtesy of the big celebration next year.
Yep. So my priorities are lying in other places right now, but we'll get there when the time comes.
So what we do here at the moment essentially is we're looking to grow together, I guess, with our financial knowledge, and hopefully we can bat some ideas between each other, take a look at some trends that are going on in the market, maybe some stories, some headlines, some news. We're also going to look into various terminology just to get a better understanding of it all. And the idea is that we're hopefully over the course of, I don't know, however long we're going to be invested for, which ideally you'd think is a long time, we're going to use these sort of podcasting episodes as a benchmark for what we currently know. And then maybe in a year's time, we can look back and go, what a cinch, a couple of noobs there making some absolute amateur mistakes. But the important thing is we'll have learned from those mistakes, and ideally we will become better investors, and we will be progressing exponentially with regards to our wealth, ? Hopefully.
Yeah. Well, we're going to...
Of
course it is. Yeah, so it's essentially to take a measure of where we are today, and then in a given amount of time, come back and review it and keep going. See what progress we made. See what hints and tips we picked up along the way. And if we have these conversations anyway, so we just recorded them.
Yeah. Hopefully we can provide a bit of information to anyone who's watching who might not have known a certain thing, or they might decide to take some of our advice and run with it. Well, We'll see. So, let's crack on then with after the introductions. Let's get on with the weekly news that we've got down. Lewis is driving again this week because I still don't have my new laptop. I have ordered it. It should be due to arrive tomorrow, hopefully, and if not, then it should definitely be here by the end of the week. And then I'll be able to actually look on the OneNote that we currently have, that we put all our ideas, structure of the reports, topics, news, and all that sort of stuff. So it should be good and running next week, not just doing it off my phone.
Yep. Right. So the weekly news notes that we made this week include, we got some robots that are going to steal some jobs.
Oh, yeah. They took jobs, as they did on South Park, except we're not talking about the Goobacks this time. We are talking about AI and automation. I think I read somewhere in the news that they reckon by 2030, 6 million manufacturing jobs are essentially going to become redundant. So we had a little bit of a discussion on this, didn't we, before when we first read the news headline. And the idea was that obviously it gets those people out of a mind-numbingly boring, repetitive job. But I argued that whilst that might be the case, unless the money that the company's saving is then reinvested into those workers to train elsewhere and gain other skills, it's got to upskill them. And if you don't upskill them, like, it's a family that you essentially stopping providing. It's a family that's no longer has a guaranteed income. So either it's going to make the gap between rich and poor even larger, or if the whole society push that we have at the moment with regards to giving back to the workers and making everything more fair that comes into place, and these people do actually get upskilled and the training that they need in order to become more resourceful, then great. That's the ideal scenario. Whether or not it will happen begs the question.
I think it always does happen, but it's a lot slower than it should be.
Yes, for sure. I think I remember. I also saw a graph today that you showed me with regards to the distribution of wealth.
Well,
in the last 50
that was a different topic, but we can swiftly move on if you want.
I mean, we can incorporate that because I think it's talking about the same sort of stuff with regards to the wealth distribution. And if we're just talking about people that have just essentially lost their jobs that are not going to be retrained and they're out of a job and they're basically becoming, on the poverty line, then I think kind of ties in there. So you did a bit of research on this one. So
yeah, well, I mean, it came out of a news article, because that's where we get all our information. But it was just interesting to see some real figures, I guess. And it kind of, you can see where you slide into this. How do the wealthiest families stack up? Well, it's poorest to richest. Yeah. So
the macro of societal and all that sort of stuff.
So it goes up in 10%, and basically it's net wealth per adult at each kind of 10% increment, and it describes wealth distribution. So 10% of UK families or 10% of UK adults have less than £3 to their name. Essentially, what the document goes on to say is because...
Is that including debt and all that sort of stuff and liabilities? Right.
So it takes into account debts. I'm not sure it takes into account mortgages.
Right. You would assume... They probably should do, really, because if you're taking into consideration the assets that you have, which means if you have bought your house outright, I don't know, I guess it depends on how much your mortgage you've actually got.
Well, true, but then do you say, well, actually, if the house is worth X and your mortgage is worth, is it X minus however many years you've got left? So
yeah, true. I suppose they need to be more clear with regards to the distribution of the rules that they've done for the statistics. Yeah. But it is quite an interesting read from when I remember seeing it. It was basically trying to stay, and it was putting the old classic generation divide pits against each other. And I sometimes think that these articles are just literally put out there to make an argument in the office or between people. And it was saying that I think it was the age category of the current 60-year-olds have the most accumulation of wealth.
Yeah, so age 61 to 70. some things are the wealthiest age group because they have an average wealth equivalent to £332,000 per adult.
Right.
And basically, many of them are at an end of a career, so they've had a chance to accumulate savings, pensions, and they've seen the most in the property growth.
Yeah, you've got to also remember, I think pension distributions or pension benefits back when majority of these people would have been going through their careers were a lot more generous, I think.
Yeah,
Had like actually guaranteed, and I'm going to butcher this, annuities, something like that.
annuities.
That's the one. It
Yeah.
could be that. I don't know how it's pronounced. I've absolutely butchered it, and I can't Google it or anything like that because I use my phone right now. But I think it's basically they have a guaranteed set income each year coming from that. Like to even think that nowadays, it's just crazy because you don't obviously get your percent, and then so you pay in. I think currently we have to pay in 5%. It's going up to 6% next year of your current monthly salary into a pension pot, and then your employee matches this.
Yeah.
Sorry, employee matches this, and then whatever growth you get on that pension pot over the years that it's in there, then great. That's your sort of drawdown for later on in life. But obviously back then, I think the rules were different, and I think that's why we ended up with such a massive pension deficit in the early 2000s because they were far too generous for what they were worth.
Yeah, so
people were quite loyal to the companies and stayed at these companies for quite a long time, as opposed to nowadays where people just bounce around and move around left, right, and centre, and the social mobility is a bit there. So it's sort of a difficult one.
I think it as well. It wasn't that the pension pot was too generous. It wasn't about like the contributions made during the lifetime of the person working. So an annuity is essentially just a continuing payment, and then when you reach a certain age, you get a guaranteed income back. It was that the age limits on those annuities were very low, so you could retire at like 55, and you might live till you're 95, and you've got a guaranteed income for those 40,
for the next
40 years.
40 years.
Yeah, so that's a huge time compared with an earlier time of pensions where a lot of people weren't living past 70. So that pension pot only had to last 15 years rather than 40 years, and that soon takes a lot more out of the pot when everyone's living a little longer.
And I think, correct me if I'm wrong, but if you opted in for that scheme when you first started, can the company actually then close it down later on? Or because you're in it now, that's it, you're in it for good?
It's not the company. It's so the company signs up with an investment firm. So although they contribute on your behalf, it's not held in your company's name. It's held in a third party's name. For instance, I think BlackRock, or they changed their name recently. But they handle a lot of the UK's pensions for most big companies.
Once you're in that scheme, you're essentially locked in then until you decide to change the scheme.
No, that was part of the agreement. Is that you were guaranteed that income. So
yeah. So they couldn't then, like, I don't know, you've been working for Jaguar for 20 years, and they suddenly said, "All right, we can't afford that annuity now. We'll pay it for your 20 years service, but we'll have to knock you down to this slightly poorer tariff."
I don't know the exact details, but I know it wouldn't be Jaguar Land Rover. It would be BlackRock because they were managing the fund.
Yeah. Sorry. They like the Aviva, the companies that are actually doing the investment. Okay,
so,
fair enough.
But as far as I understand it, that annuity is essentially a guaranteed income. There's no regardless. It's not like a contract.
Yeah, I mean, so it's pretty sweet when considering that we don't get that. It's a fraction of your salary as well. Like if you'd finished your salary on £70,000, I think it could have been anywhere up to like 50% of that each year that would have been guaranteed. Like that's 35 grand for like the next 40 years that you've just locked up.
So you've got two types of annuities essentially. There's a lifetime one and then a fixed term one. So you can usually have like because you can have almost private annuities where you contribute on your own behalf. Obviously, there's no one matching that, but then basically you take So when you use the money from your pension to buy an annuity, you can take up to a quarter of it tax free, and then
Right.
you then use the rest to buy an annuity for the rest of essentially however long you want it to last. So it's kind of like a trade. So it's not that you contributed to an annuity throughout your life. It's that you contributed to a pension fund and then you traded that pension fund for an annuity. And obviously, the larger the pension fund,
for a safer player. Okay, that makes sense.
But then obviously it's taxed like a normal income then.
Right. But still, if you're getting a fat wedge from it, I don't think you're really going to be bothered, are you? What else are you spending it on when you're that to that sort of age? Not that we would know, because we've still got another 50 years before we get to that age.
There's all kinds of different. It'd be an interesting topic to talk about, though, to learn about.
It probably would be, pensions for sure, but I don't think I have the knowledge or the research yet to be backing that up.
Well, we just build on it, don't we?
Yeah, okay. True. Right, what's down the line next? What are we
on? Well, I mean, before we move off the topic of wealth,
I think we're going to leave that for the main topic after we've just run through the news. If you want, we'll blitz through the news and then we can talk about wealth in general with regards to what we used to think it was, how we think it is now, and then what you would class as a wealthy person.
Then. So, Mr. Trump on the China trade war.
Yes. Gold jumped massively, didn't it, last week?
Yes.
There were all talking. People were trading in Rolexes because gold has been at the highest it's been for the last 6 years, and everyone was going up in arms, thinking it could go up to $1,600 an ounce. And then Trump's just basically poured cold water on that by going to G20 summit and then saying there's going to be a truce now between him and China for the time being while they're trying to thrash out another trade deal. So now everyone's going to be jumping on the bandwagon of, global trade's going to be back on the agenda. We're going to be massive growth next year because if these two iron out the kinks between the relationship, it's all good. So it's one swing to the next swing to the roundabout, and that's where it's going at the moment.
US markets were very high, weren't they, on the back of that? Yeah.
Yes, they did. I think they were also going to go high as well because I think they were pricing in a US interest rate cut. I don't currently know what the percent points is over there. I could be wrong, but I think it's around 2.75, nearly 3%. And because their economy is starting to slow down a little bit because the effects of the trade war are now starting to bite, I think the Fed was quite keen on perhaps knocking it back down a couple of percent. Well, not a couple of percent, but like maybe 0.25, something like that.
To encourage growth.
Yeah. The problem is now is if these talks end up positive and then the economy starts speeding up again, they're going to... I don't think they're going to knock it down now. I think they're going to play the attitude of wait and see. So I don't think they're going to make a decision. They're going to see how these trade talks pan out first before they decide to re-rate the current interest rate over there.
Fair enough. We also had the topic of the Opec to extend its oil cuts for another 9 months.
Okay. Yeah. So the OPEC meeting's currently going on. The cartel is currently meeting right now. I don't know where they're meeting this time, but basically the main topic of the agenda was going to be whether or not they're going to keep enforced the 1.2 million barrels of oil a day cut that is spread between I think it's 13 countries, could be wrong, but basically it's spread between all the countries that are involved in the OPEC cartel. And then in order to have a more deeper impact, there's this thing called OPEC Plus now, which also includes Kazakhstan, Russia, and a few other countries as well. But essentially, because they need those oil prices to be better for their economies, they sort of limit the market, and then that pushes up the prices a little bit with regards to the crude oil. So I think Putin himself came out and said, Russia are definitely going to commit to another 9 months at least at these levels of reduction of 1.2 million barrels a day. So that's going to prop up prices. Obviously, OPEC are going to be delighted with that. It might also de-escalate the tensions a little bit in the Iranian Gulf, but I'm not quite sure because another topic that we're going to talk about just after this is that Iran have started enriching their uranium past their allowed allowance, which indicates that they might be starting to stockpile uranium grade quality for nuclear weapons, and obviously if that starts ringing alarm bells, bigger countries like the US or Saudi Arabia might decide to take some action. And obviously if there's a war that kicks off there and one of the busiest shipping lanes in the world for crude oil, then you can expect prices to absolutely go through the roof.
Fair enough. So is that the same as what's going on in British news? I guess European news. G20 review. Yeah.
The G20. G20 is not European. That's more I think it's the wealthiest 20th. The wealthiest 20 countries in the world have all met in Osaka in Japan, and they've basically just been, I guess it's more glitz and glamour and just for showbiz and appearance and stuff like that. I don't think anything really got done. No one really confronted Saudi Arabia for the journalist that essentially got killed, that had a hit list. Putin's basically declared that liberalism is dead. No one's really confronted him about that. May had a little bit of a spat with him with regards to the injustices for the people that were killed by the Novichok poisoning. But again, no sanctions, nothing like that. And then Trump spat his dummy out with regards to the climate change that all 19 of the other countries agreed on. They wanted to get zero emissions by 2050. Trump didn't want to risk the potential job market for his factory workers and the American workers, so he's not prepared to commit to that. So a lot of peacocking, not sure a lot of stuff actually got done, as with most of these sorts of global
Well, if you
meetings.
put 20 people around the table, man, you're going to get to talk about 22 different things, aren't you?
You really are.
Yeah.
So that's that.
FCA confirms CFD crackdown.
Yes, that is an interesting one. So the Control Market Authority, correct me if I'm wrong with that abbreviation.
Financial
so the one that look after the stock market.
Controls Authority.
Yeah. Yes, that's the one. So the Contract for Differences, which is a CFD, it's the same sort of principle as spread betting, but you're using leverage, and it's just for normal sort of stock trades. So the main point for this is that, do you know when you see all these adverts for ETX Trader or global markets and financial tools, and they're advertising for you to come and use their platform, and then they see in small print 80% of retail traders lose all their money? They are now, as of the 1st of August, they are now no longer going to be able to aggressively advertise that sort of market platform to the common sort of private investor. So the individual investors.
Do you reckon that's on the back of the gambling stuff?
Yeah, it's for people that don't really know how to use
the
tools
and
not
as
been
in
trained
like,
how to use.
Remember the gambling market got attacked, didn't it? The gambling market got attacked because they were advertising, come use our platform, you can basically get rich quick type thing. And then it was the payday loans thing. And then the government stepped in.
You're probably right. It's probably, it's trying to protect normal people. I say normal people. It's trying to pick people who are easily enticed in by these sort of glitz and glamours in seconds, and they don't really do their own research. They don't do the training necessary. They just wade in there, balls bare, and say, right, make me some money. Here's 5Gs. Let's make it happen. And then 2 days later, they've got a debt of 50 grand and they can't pay it back. So there's two things that might happen with this. Well, I don't even know if there's two things. I think the main thing that's going to happen with this is that you might see. So you know how the spreads are so tight at the moment with regards to a lot of these markets because there's quite a lot of competition and people want to attract people to each side. The spread is the difference between the sell of a current share and the buy of a current share. Do you know when you can see you can buy it and when you sell it's always at a less price than what you can buy at, right? That spread's usually quite tight. I think the amount of revenue that these platforms could now potentially lose because of the people they're not going to bring in because of the adverts might mean that they might start to extend their spreads in order to make more on the margin because they're losing out on all the potential new customers. And if you think about it, then they've got less people using the platform, less people are willing to just piss money away, essentially. So they've got to start bringing that revenue in from other areas. So I reckon you could start to see the spreads starting to creep up a little bit. I don't know about you, whether you think that makes sense, whether that's a fair analogy. I mean, the logic behind it seems there.
It could be. I don't know.
But obviously, they'll be like, oh, no, we won't do that at first. We won't do that. We won't touch our spreads. We'll keep it competitive. And then, when results come round at the end of the year and they realise that the amount of income that they've lost puts them in negative numbers, suddenly you'll see them starting to change the tune. So you might not be seen straight away, but there will be a knock-on effect somewhere along the line with regards to profits that they're going to make from their platforms.
Fair enough. We also made the statement last week that water companies tend to be a safe investment.
Yeah, we did. And then literally a day after we'd made that statement, there was a massive news story that Southern Water had been lying with regards to their... I wouldn't say lying. They've been manipulating their final effluent discharges from some of their wastewater.
Misreporting its performance.
Yeah, misreporting its performance. Everything's well and dandy, and this is not something new. They'd been doing this for about 8 years. I think they got busted for.
I don't know. It doesn't say in this report.
8 practices that have been. So in the end, they were fined. I think it was 120 million pounds, of which 123 million will be given back to customers, and 3 million worth of pure fines.
So not such a safe bet.
Well, I mean, maybe not such a safe bet, but they are privately owned, I think, and they are not currently on the stock market. And as with a big story like that, I think all the other water companies didn't really move that much with regards to the news. I mean, sometimes you see, like, for example, when BP's oil disaster happened, other sort of peers would have taken a little bit of a hit with that because it was all in the news. People didn't like fossil fuels. It's like, oh no, it's doom gloom. They took a little bit of a hit because of BP. Didn't really happen with the water companies here with regards to Southern Water getting that huge fine.
Fair enough.
And then the other thing that we pointed out this week, the final bit of the news, was the Chris Woodford Equity Income Fund.
Chris?
Did you see that? Put down.
Neil.
Neil. Sorry, Neil Woodford. My bad. I'll hold my hand up there. Apologies.
Yeah.
So originally, it was thought that he only had about 10% of the equities fund in illiquid assets. It's now been revealed at a hearing that it was up to nearly 50% of his portfolio was in illiquid assets.
So basically, he can sell up 50% of his fund. Yeah.
Can't sell up. You can't provide the money for the people that they want it when they want to take it out. And it's now gone past the 28 days that they've been holding it locked up now for people to not be able to recover their money. So I'm not quite sure now what the procedures are. I mean, they're not informed the market when they're expecting to open up the account again. They've still not waived any of the fees. And I think I saw a figure today that they reckon in the 28 days or however many days it's been now since the account's been suspended, that them fees have racked up to 2.8 million now.
Wow.
Pounds, which is a substantial amount of money considering it's been a month.
Well, apparently 5 minutes before we went live, they've just announced that it will be remaining locked for a further 28 days.
Oh, wow. So that's another 2.8 million in the bank then.
So the extension was widely expected. But, remaining investors has expressed their frustration because they're unable to access any funds.
I found it ironic with the article you sent me with regards to Hargreaves Lansdown, basically saying their name has now been dragged through the mud because of this whole scandal. But they were happy to get into bed with him pretty much as soon as he would come out of the financial crisis, and his reputation was there for 2008, and they was aggressively pushing his fund up until January this year, despite knowing that, well, they must have known that his portfolio was in that state.
There's a bit further, to delve in there a bit further, essentially, he's been trading on their platform. They're the provider for his management fund. And essentially, they've been promoting it, even though I think the grand total... Where is it? Yeah. So since its launch, the actual analytic study shows that it's only like gone up by 0.36%.
What is that, including the crash that's just happened in the last 2 or 3 months?
So I don't know.
Because that's
Yeah.
returns.
So like in its first year it made 18, but then over the grand total of its lifetime so far, I think it's about 5 years, isn't it? It's 0.36. But
Wow.
according to it only manages 3.7, whereas it originally managed 10.2 worth of assets.
Right.
So some big figures there, or drops in figures.
Big drops in figures, and the fact that they were still pushing it hard as well just says, well, I mean, you can make your own judgment with regards to that, can't you?
It also raises some concerns because I think it's 2 weeks ago now we only just started to discuss what funds were and kind of trusting someone else to make those executive decisions. But
yes, it makes you wonder whether or not do you really want to let someone else take responsibility for your money, especially when
there could be a clause that you couldn't even get it back when you wanted it.
Mistakes and typhoons like.
Well,
this
it's not even the mistake. It's like sometimes you're gonna have to cut your losses, but they can't even cut their losses right now.
No, they can't, no, because no one wants to buy it because it's in illiquid.
But that's what I mean. Like if you got money locked up in there, and you can't get it out, like you physically, there's no possible way to get your money out there. It's just
no, and yet you're still paying him fees. You're paying him fees to take hold of your money, to take hostage of your money. You literally money. It's like, oh yeah, mate. By the way, put this gun to my kid's head, and I'll keep paying you money.
Yeah,
ridiculous. But the risk in it, that is the risk. And unfortunately for him, that's his reputation completely ruined now. I don't think it's gonna take a lot for him to come back.
Yeah, true. But the Hargreaves Lansdowne point was I think they've earned about 2.4 million in fees. Yeah. So okay. I don't. There's still stuff coming out about this story, so it's hard to like draw a conclusion. But essentially,
some ethical sort of responsibilities here that need to be addressed, and hopefully the CFA might start probing the nose around with regards to how these funds are run.
Definitely. I know that it says here that they're due to get involved because they're, well, I think it's to do with how long he's allowed to suspend the trading.
Yes, that's correct. Because it's going to be coming up to what, 2 months now? It's going to be suspended. That's like quite a lot of time if people need the money.
Yeah.
Right. So I guess that rounds up the news for the week. What are we going on to now?
Well, have you got anything to review?
Well, I've still not got around to writing up a book review for Never Difference.
You haven't got a laptop,
like I mentioned. I've not got a laptop. I can't really do it during work hours, and I'm currently revising for my exam on Sunday for my Japanese, and I've also got my iChemie professional chartership technical report interview on Thursday. So yeah, I'm kind of gridlocked at the moment. But once all this is out of the way this week, I will definitely start wrapping up those reviews with regards to books and to potentially doing university degree courses. I can give you a quick review with regards to how my portfolio is doing if you're interested. So, as I mentioned maybe 3-4 weeks ago that I'd purchased some stock in the John Wood Group. It's a oil servicing firm. That's WG. So initially I put £1,000 in when they were at £4.90 because I was quite interested in the dividend yield. I thought it was a good return at that level. Even though I did think it was going to drop lower, I still put some in because if it did rise, then I would have missed my entry point and I would have had nothing to show for it. It did fall. It fell further. I think after a month or two, it was down at £3.90. So the rest of the money that I had left waiting there, because I didn't put it all in at once, I had a 50% split. I then put another £1,000 in when it was at £3.90. It's bumbled around that sort of price for a while, and then last week they released their half-year results, and those results were good. And in the following week that's gone, well, basically just passed, it's now shot back up to £4. I think it closed today at £4.76. Cool. So that's it's nearly a quid up from the £3.90 that I bought in at, and because I did the two averages, the one at £4.90 and one at £3.90, my average dropped down to about £4.45. So I'm now in capital gains profit with that, and then obviously when they start paying the dividend, the next payment for the dividend, I'll be getting dividends as well. So it's looking like I've got in. I wouldn't say I got in ideally because I got to put the £2,000 in when it was quite its year low, but I find it a nice entry point. I do think that the oil it's not just an oil and gas servicing, like it's not particularly specialized in that. It's also started to branch out into renewables and energy. So it's got 25% of its income and revenue come from renewable markets. So it's not just exclusively to the oil and gas. So in the future, when everyone's pushing for this climate change and people are looking for alternate technologies, this company's not going to fall on its ass because
it's positioning itself well, isn't it?
It's hedging its bets. It's not completely going for it, but it's putting itself in a good place. Pays a nice dividend. I think my dividend yield now is at my new average down price is 6.5%, which for a FTSE 250 stock is pretty good. It's not in trouble at all. I can't see it. Its revenues were good. Its profit was good. Yeah, there's still a bit of debt hanging over its head, but I mean, what sort of massive company doesn't have debt above it? I mean, BP's got nearly $40 billion worth of debt above its head. So that's the roundup for Wood Group. The other news is that I hold stock in Hurricane Energy. So I remember a couple of weeks ago I mentioned that they had their first revenue coming from their first fractured basement that I talked about when they hit oil there. Unfortunately, today they released a statement. It wasn't such good news. Their drill that they had in the greater Warwick area, it encountered some difficulties. It did find oil, but also found quite a lot of brine and water in the actual slug. So they decided to plug it and abandon it. They're going to take the data and move forward. They reckon that it was due to do with the fault and the construction of the particular area that they drilled in, which was giving these figures. Obviously, the market's reacted massively bad to this. It's dropped 20% alone today from 53p down to 43p. Yeah, it's a bit of it's knocked the wind out of the sails a little bit, but from the way I see it, I'm not going to be changing my position because they're generating revenue now. They weren't in that position a year ago. They've got an actual well up and running, producing that. They're going to get a lot of data from this well, and then you'd like to think when they've got 6-7 months worth of data, and some of the bigger oil majors might start looking into this thing and say, well, they've got a fractured basement that's working. There's massive amounts over there in this particular patch of territory.
I don't know what you call it. Real estate.
So I reckon I'm not bothered by the 20% drop. I'm still above my buy-in price anyway, so I'm still in profit. I was always going to be in for the long run for this. I mean, you expect this with exploration companies. You can't expect to hit every time with the black gold. Sometimes it's a win, sometimes it's a loss, sometimes it's just it were okay. And I think for this, it's still a long haul game. I mean, the well they plugged is not even, they've not even paid for it. This was part of the farming package that they had with the Spirit Energy that bought in last year, and they've got another 2 wells for this exploration period that they're going under. They've got another 2 wells that they hope to do for that in this year, and then they've got another 3 planned for next year. So it's still, the first one's bad, but I mean, you'd rather start on a low and get better than start on a high and then everything else falls. Right?
I guess. I mean, well, it's. Yeah.
But I'm not going to change my position. I think I'm just there, and I think I was in it for the long term. I'm in it until a takeover comes in. I want to see a takeover from one of the big boys that say, right, you proved it works. We like what you've got. We'll buy you out. And I'm hoping it's going to be a multi-bagger still. So I'm maintaining the faith. And then other than
no
those
dividend
two,
on that one. Then that's just a small. No,
it's no dividend. No, it's a small. Yeah. It's a small aim cap at the moment. Although it was valued at over $1 billion before the 20% crash today. So that's going to put it down at what, 0.8, 0.75 million, no, 0.75 billion. So it's still quite big for an AIM stock. It could well easily be on the general market index, but I think they're going to stay on the AIM for a while, and we'll just see how they develop. But they're in a lot better place than they have been in the last couple of years, and I'm going to keep the faith.
To be honest, I checked in with my account today when I saw you'd added that note, and not a lot's changed.
had no news articles or anything like that that's come through for the last half-year results for any of the
No,
companies that
I've
you're
seen.
in.
So, to be honest, I haven't checked in, but essentially, Virgin Money and Clydesdale Bank. Was it Clydesdale?
Yeah, Clydesdale.
They've had this merger. It's been kind of a lot of ongoing changes. So they're meant to be launching a whole suite of digital products that is meant to change the financial world.
Yeah, because they're claiming to be a challenger bank, aren't they?
Yeah, so obviously they're not nowhere near.
It's
Yeah,
not the
nowhere near the big. What is it? Big five, big four? Can't remember in banking terms.
Yeah, HSBC,
RBS,
no RBS. Sorry,
Santander.
Santander.
It used to be Lloyd's. I don't know.
Lloyd's, TSB. Yeah, I think they split it, didn't they? It's just now Lloyd's, and then TSB is its own separate branch, and then Barclays as well. Is it NatWest? Would you class that as a big one?
I don't know what their size is. I know HSBC is huge, though, isn't it? That's one of the biggest.
Yes.
But yeah, essentially they're meant to be kind of modernising it.
Streamlining the process, making it more digital and hipster.
Yeah,
friendly.
basically, just get people involved with ease rather than, banking seems to be a challenge because it involves actually seeing people all the time. Well, less and less these days, but yeah. So hopefully they got some good ideas, and hopefully that'll see some growth soon. But it just seems to be stagnating.
You were thinking about taking it out of that, weren't you, and getting a better dividend yield somewhere else? Are you still looking at that, or do you need to do a bit more research into a company that you fancy?
I'm not going to take any out at the minute. It still pays a dividend. If anything, I need to be. I've got no reason to take it out, to be honest. No.
Fair enough. Any other news? What other shares? Any other share news?
No, just when I was reviewing my portfolio, obviously, from where I were when we had BP, a couple of others, paying some quite nice dividends.
BP, I think we sold them at quite a nice
I made a good profit on them.
What are we buying it? We're at about £4.20 we bought it, and then we sold out at £5.80. So that wasn't bad, man. That was a decent little trade that we did back in the day when we were first coming out.
But obviously that paid a really nice dividend, didn't it? So I'm missing that dividend, to be honest.
Well, you're still paying off your fees, though, aren't you? Right, with the dividend that you get coming in.
Yeah.
Wow, that's the main thing you got to cover, because if you don't do that, they start selling your stock without your permission in order to claim
I've got a little bit of cash sat in that account anyway, so that'll cover it. I know it sounds pointless having cash sat there, but I want to be investing a bigger lump to.
Yeah, because otherwise your transaction fees just cost too much. £12, then stamp duty, and then
that was another thing actually.
I'll be doing that for only £60.
I was reading. There's a couple of other platforms. Because obviously Hargreaves and Lansdowne is the big friendly, kind of big boss platform at the minute.
Yeah, it is at the moment with regards to.
But there seems to be a few others, and they're not new. They're just not as user friendly. So as soon as you know what you're doing, there's ones where the maximum trade price, the maximum purchase price is only £5, and then there's another one that's even lower than that. So as you increase your trades as well, it might be something that I'll look into later. And they offer the same kind of products, the ISAs, the LISAs, you just don't have to pay that trading fee.
Yeah. So. Yeah. Well, interestingly enough, it's funny you should say that. There's actually some mobile apps out there where you can do it commission-free, trade-free. It's just whether or not, I don't know, you trust them, or they offer the same sort of service and the same sort of markets that you can get on Hargreaves Lansdowne. Because I think you might only be able to do it on FTSE or FTSE 250.
Yeah.
Things like, have you ever heard of Robinhood?
Nope.
They're supposed to be a trading platform where you don't pay any trading fees or anything like that. So they are out there. By all means, if you don't want to pay fees, then you can definitely find platforms and stuff out there to do it. It's just whether or not you're doing it professionally, or you're doing it casually, or you're wanting to get involved in certain markets that they might not have access to. Like, you get quite a lot of Hargreaves Lansdowne. I guess it depends how frequently you're going to trade as well. Like if you just stick it in there and hold it for a while, then management fees aren't really that much of a thing. But they do make up if you're making 6 or 7 trades a month. Yeah, for sure.
I don't know. It's just I guess it's.
Yeah, and obviously the good thing is the more competition there is from these other companies that are providing the same service, you would assume that competition will kick in and they will be competing to try and lower their fees to keep customers and then bring new customers in.
Yeah, true. Because as other platforms get better, they get access, they get the custom. With the customers, they get more access. So then, it's just keep our options open. Understand, there's not a lot of difference when you're buying and trading. Like, you're paying a premium to do that on Hargreaves Lansdowne.
Yeah. It's just the interface just looks nicer. I guess it's all set up in nice colours. It's easy to navigate around. But like you said, once you've learned a little bit with the other website and you got used to it, then
if it becomes a regular thing and you're trading often, I don't think it is for either of us right now. I'm just talking.
No.
Yeah, theoretically that it's out there. It's an option. There's quite a few that have been around, possibly a similar length of time or even longer, but just don't have that user base or user.
I probably didn't have a successful market campaign as what Hargreaves Lansdowne have done.
Yep.
All right.
Yeah. So that kind of finishes off that. Yeah. Topic of the week. We said we were going to talk about wealth. I guess.
I don't think it's going to be a huge topic. We could still rattle on about it if you want.
Well, it's up to you. I mean, I guess it'd be nice to talk about what we thought wealth was, a couple of years ago. Like,
I guess I thought wealth was a couple of years ago. I just thought it was just how much money you had in the bank and where you lived. I wouldn't say anything had any recognition. Like for me, saving your money in a bank was like that's how you got rich, and that's how you got wealthy. When now, like my eyes have completely opened, and saving in the bank's not the worst idea that you could do because you could, be taking out loans, you could be pissing it away, and various other sort of luxuries.
Yeah.
But just leaving it in the bank to gain interest is probably not the best way, nor is it the most effective way to get wealthy now. But I think also my view of what wealth has changed as well. Like before, it was how much money you got in the bank. Now I would say a wealthy person can be someone who's not necessarily financially rich, but they have a lot of, I'd say free time, but they have a lot of time to do what they want to do. So like they value their time, and like they've got to a point now where they have enough wealth available to them, so they are essentially, I guess, financially independent. So they don't have to work if they don't want to, but they have time to do what they're interested in and invest their energy into. So I guess for me, it's not just wealth. It's not just tied to just the figure that you've got in your bank account. It's tied to your assets, obviously. It's tied to your liabilities. It's also tied to how much time and effort you spending as well, doing things that you don't essentially want to do, but you have to do for ends meet. Do you know what I mean?
Yeah, so I guess, to look at it in a different light would, essentially it lets you do the things that you don't want to do. Sorry, it lets you not do the things that you don't want to do. So double negative there. Yeah. So as in, if you're not particularly enjoying a certain thing that you're doing, when you've got money and that kind of freedom, then essentially it lets you not do that anymore. You can turn that down.
Yeah.
You can walk away from certain things. I think I talked about that Naval kind of podcast that I was listening to. I was about halfway through it last week, and I finished it off this week. And essentially, he does sum up some of those points. I think one of the sayings that you hear is, "Money doesn't solve your problems." Have you ever heard that? Like money's not the answer to your problems or something along those lines.
Yeah, I've heard that before, yeah.
But essentially, what he says is, yeah, that's great, but money solves your money problems.
Yeah, for sure. Yeah, like your rent
Yeah,
bills are
money buys you the
chaos.
freedom in a material world, and that
Yeah, and then it's up to you to solve your problems with the freedom that you've got
yes,
from.
yeah. So
Yeah.
like, money is not the end goal. Money just puts you on the next step to solve your other goals. When you're not worrying about
I
money,
think
it gives you a lot of sense of, right, now I know what I really want to do because I don't have to worry about that anymore.
Yeah, it's a problem. Like not having money is a problem, but then once you've got the money, like that's the only problem it solves. But it's a big problem for a lot of people because there's just that much pressure over people's heads just to stay afloat, essentially.
Yeah, and I think a lot of it as well, like it's it's like a subliminal, like kind of how would you like? It's almost a competition, but subliminally. I felt that. I felt when someone's not bragging, but it does feel like they're bragging when they're talking about I got a raise. I'm now earning X amount each year, like, and I get a 10% bonus each year. It's like, well, good for you. Like, what are you doing about it? It's like, oh well, now I'm going to work harder and get even more. And it's like, well, that's not what I do. Like, if that makes you happy, crack on.
That's the thing. That's the thing you've got to realize about wealth as well. I guess is that I don't think hardworking. Don't get me wrong, hardworking people can get wealthy, but if you're just hardworking, it's not necessarily guaranteed that you're going to become wealthy. I think to get wealthy, you have to be smart.
Yes.
Like you can have an 80 grand a year job and you can end up very wealthy. Or you could have a 150 grand a year job and you could still be dirt poor because you're not investing your money. You've got X amount of expenditures each month. You've got your car, your transport fees, you've got your alcohol that you like to drink every other
cost
weekend.
Of living, isn't it?
Yeah. So you don't get to become wealthy. It's a certain lifestyle, isn't it? For sure. Like that's the main thing for me nowadays. Is like wealth. It's not earned. It's a choice to some aspect as well.
Yeah, like it. Yeah, I agree. I've heard that saying before.
Like you've got to work hard as well, but you've also got to be smart about it, and you've got to make the certain decisions in order to get your wealth to the next step. Like I've just mentioned, you can be on 500,000 a year, and you could still end up with massive not mortgages, but massive credit card debts at the end of each month.
It doesn't even have to be a credit card, does it? It could be any kind of debt. Like it could be.
You're living out your means, aren't you? You're living in excess and of what your current financial situation is, and because you're ignoring it and not choosing to address your lifestyle, you're not going to be wealthy.
Yeah.
You just appear to have a lot of money when you don't.
Yeah. So like it is that choice thing that, if you choose to live with a little bit less whilst your income grows, because it's in and out, isn't it? It's right. You've got a certain amount coming in, and you let a certain amount out each month or year. And if
that's just the basic concepts of saving, though, isn't it?
No, it's not about saving. It's if you're spending more than you're earning, it's a net negative.
Yeah, for sure, it's a negative. But what I'm just saying is that's just the first block of how to save money. It's then like you can save money, can't you? But if you've just saved money all your life and you've only had it in a 0.25% savings account for the last 50 years, then arguably the inflation's been just eating away at it, and you're probably going to end up less in real terms than what you actually think you had. So the first step to gaining wealth is to adjust your lifestyle to what you're currently making, and then the next step is to make that excess money that you now find yourself with to work for you whilst you are currently working with a job. That's when the time aspect comes into it, isn't it?
I don't like the word job.
So if you can, well, it's what it is.
No, it's work
at the current moment in time. Work.
Yeah.
If you're working your current.
No, if you're doing work.
If you're doing work and getting paid, and then your money's also making you money as well, or making you wealth and growing your wealth, then you're essentially getting more for your time.
Well,
and that's when it comes back to the whole wealth concept.
You have two assets, right? Like the basics of it is you have two assets. You have your time and you have money. And if you don't have a lot of money, you need to invest a lot of time. And if you've got
Yeah.
no time, you need to invest a lot of money. And what that's like, for instance, if on a Saturday morning you could go earn, I don't know, £100 for an hour's work, but actually your grass needs cutting, but that's going to take an hour.
Yeah.
It's more valuable to pay someone 30 quid to go cut your grass, and then you go earn your 100 quid, because then you've got a net positive of 70 quid, versus you don't go and earn the 100 quid, but you cut your grass. Yeah, so like the time is more valuable, but it only in the sense that because you've got earning potential with that time.
Yes.
So like it's all well and good saying, oh well, I've got loads of time but I've got no money. You then need to figure out, well, how are you going to earn money with that time? But then there's a shift, because at some point the thing that was paying you X amount is also might not be the wisest thing to spend your time on, because you could be earning more elsewhere. But because you're used to working doing that, so let's say you've got a job, you're used to working 40 hours a week for a salary, but actually you've also been putting some side business, and doing that now and again. There's going to be a point where that side business could be paying you more.
Yeah.
So like,
and you could even just like I'll work 4 days a week now. Yeah. And then I'll do it a day purely on the side business.
Yeah, but it's understanding, where that earning potential is, how to best invest that time. And sometimes it's almost seems backwards.
So ultimately, it's come down to wealth is how to best manage your time.
I guess it is. It's time management.
In terms of earning potential.
Yeah. I think so.
Which, for sure. Like the wealthiest people don't get there without managing how they spend their time.
I think 100%. As well, like some very smart people are not necessarily the highest paid people in the room, because they're not very good with time management.
No, because they want to get the detail absolutely perfect, or they're
so close to perfect.
Yeah, they're so zoned in on this particular area, they don't take into consideration what's going on around them and how the dynamics might have changed to the situation.
Get lost in the detail.
Yes, they spent this. Like you said, they're focusing so much time into this one topic and area that they've not taken the time to have a look elsewhere and see what else is going on, and they've chased themselves down this rabbit.
When someone else has already fixed the problem.
When someone else has already fixed the problem, well, they're already making profit from it. Like, so it's time management for definitely like wealth.
Yeah.
So yeah.
But like, as your earning potential increases, and it's your time management, you'll have essentially you can trade time for money, but at some point you're going to need systems or people, one or the other, in place, and that's the only way you can scale. Because you can only trade a certain amount of time, right? And that's...
I'm going to say it's 156 hours a week? Or 172 hours a week you have, don't you? I'm just saying that's how much time you have.
Yeah. Even if you work to double shift every day, like you're working 80 hours a week, right? So like at some point, that's not going to work for you anymore.
Well, it's not going to work for you anyway, is it? Because your performance is going to drop, your motivation is going to drop, because you're just working yourself to bone. So like that's going to decrease your earning potential, how much someone's going to pay for you, because you're doing a crap job.
But essentially, that's where you need other people and other systems in place. So if you can pay someone else to do, 10% of the stuff that takes up your time, or even, pay 2 people and they do 80% of the work and you only have to do 20%, you get a bunch more time back. You can then manage other people or systems. Like, you can have systems these days. But this is what that podcast talks about. It talks about, it's all well and good, but remember, it's a constant increment. So like once you reach one step, you then need to be looking for the next. Okay, I'm running out of time now. I need systems or people to continue to grow.
Yeah, you're definitely spot on. I think a lot of people get absorbed in the money, and they sacrifice a lot of time chasing the money, as opposed to not focusing, but analysing how much time they're actually willing to give up and whether or not, like you said, the benefit is worth that. Like if you're doing 6 to 7 hours overtime a week unpaid, like really?
So I think if you're still very young in your career and you're genuinely learning something valuable, like it could be that the person in the office at the time that you're learning from is teaching some really valuable lessons that you couldn't learn. But if you're just sat there plodding away, dashing, like just typing away on documents and spreadsheets,
if you're sat there waiting for your boss to go home first before you leave your desk, and you what you're wasting your time. Just get yourself out there, just go, or at least do something productive that's not work related but beneficial for you whilst you're sat at that desk waiting for your boss to go.
Yeah, definitely. Like.
Your time, you got to look at time as a resource because a lot of people just don't.
Well, it's all like that's one way because people measure it by money. So like if I told you right, I earned £200,000 last year, and you were like, oh man, like what did you do to earn that? Oh, well, I worked 80-hour weeks for 51 weeks of the year. You'd be like, it's not worth it. It's not worth it because
probably
you don't have time
not.
to do anything else. Like. And you probably
don't.
spent half of that.
Is it really worth? Is it really worth that half a year that you get? That you got to go to the Caribbean Golf Club and go play golf?
But what if someone else earned like, 20 grand a year, but only works 4 hours each month? Like, there's such a difference. Like, there's such a difference in measuring wealth. Like, it's obviously unique to each individual person and their values, which is like, again, we try and compare it, but
it's definitely starting to go towards that way though, because there's a lot of like research that people seem to be doing at the moment with regards to 4-day weeks and the benefits and all that sort of stuff. So I think the attitude is slowly starting to shift, but this also rolls back to the inequality, doesn't it, at the start of it all? If you start making AI more productive and taking away the poorer people's jobs and not retrain them, then they need to invest even more time to even keep the head above the water, and rich people have even more free time. So, yeah.
The other thing there, though, is that working week, that was basically an experiment. I think it came out of, Henry Ford, the Ford factory? So essentially, he tried a 30-hour work week and saw his production levels were X amount, and then he tried a 50-hour work week and he saw that production dropped off. And essentially, it was a test, like constantly testing, revising, and he settled on a 40-hour work week for the most productive kind of, I guess it is a manual handling job, or it will have been at that time, like manual labour. Yeah. But then somehow that got adopted into the office. It's like, no. Why is no one looking at this? Like,
no. You guys need to start right there and change the whole dynamic. But yeah,
like, it's a completely different working environment. Like mental awareness and kind of mental motivation is just completely different, isn't it?
Yeah, for sure.
Like,
for sure.
I think in that Naval podcast, he talks about it. It says working in an office or working on a job where you have to think is very much like a lion hunting. It does a lot of work in a short amount of time, and then it sits around and rests for the rest of the day.
Chills in the savannah, soaks up the golden sun and the women around it.
Yeah.
All right, mate. Well, I think we've pretty much picked a good moment to ride off into the golden sunset on the back of his lions for this week. We will be looking to get the challenge up and running for our ETX Trade Pro accounts on this Thursday. We're going to hopefully try and do a live session. Hopefully I'll have my brand new laptop there and we can start locking in some trades that we're going to open up on Thursday when the market starts open, and we can actually start this challenge. I think for the first challenge, we're going to go for maybe a couple of weeks, 3 weeks, and we're going to exclusively trade the FTSE 100 stocks. We're going to start with 10,000 ETX credit money, and obviously the winner is at the end of the challenge who has the most money in their account, whether that's a profit or whether that's in fact a loss. So yeah, we're going to be trying to get that up and running on Thursday. So if you're new to the platform, like we are, this could be a great idea for you to
join in, see how you go.
See how it works. See how we struggle through it. See if we can actually get around to putting some stop orders, limit orders, and all that sort of jazz on it. What kind of methods we're going to use to buy into it. You never know. There might be nothing that we want to go into straight away on Wednesday, but we'll still have a play around with the program for you. So we've not got a specific time yet, but I would have thought maybe 7 o'clock, 6 o'clock, something like that. Depending on. Yeah, we could probably. I mean, we do have a Twitter page. We do have Facebook.
No, we don't have Facebook. We're trying to use Twitter.
We got the Twitter space. We might send out a cheeky tweet when we're going live if anyone's following us. If not, then just maybe you're going to catch it on YouTube later on down the line. So yeah, this Thursday, going to try and get us heads around that and start this challenge. So yeah, that's all from us today. Thank you for watching. We hope you found something useful today, and if you didn't, well, we're sorry that we just took up some of your valuable time.
As we just discussed, your time's worth money. If you didn't learn anything, sorry.
You didn't learn anything. Amazing faces and wanting to watch his jaws move for an hour and a half. You've well spent that time.
Well, we'll catch you in the next one.
All right, thank you. Bye.
Thank you.